Good afternoon, everyone, and thank you. It's day two, and look at the room. It's filled. This is great to see. So it tells you that we've had a lineup of great speakers, and we're going to continue that trend right now. We're going to be speaking on the topic of secondaries and continuation funds. Now, I have to admit, a few minutes ago, we had their partners up here, Lenore and Stephen, who spoke about this for about 10 or 15 minutes. It took away some of our thunder, but that doesn't matter. We got two very talented people, very experienced in this. One of them is their partner, Joe Zargari, who's sitting over there. Somebody log into the. Oh, Marty's.
Well, you know what? Somebody logged in.
Oh, okay. We figured out. Anyway, we have Joe Zargari, a partner of Morgan Lewis. So he is here, and his partners are the ones that were still in his thunder. So can't feel too bad there. And we have, I like that echo. If only I could sing, you know? And we also have Megan Leeds here. I'm sorry, Megan, I'm tripping all over that. Execution principal at Coller Capital, one of the premier secondary firms that's been around, long track record in doing this. So a lot of wisdom to be had from her. And I'm going to start this a little bit by telling a story. So 4 or 5 years ago, a VC friend of mine called me. I said, how are things going? You know, the fund and everything. This fund's been around for a long time. It's done very well. It's 3x. He goes, but we have one asset left. I said, you have one asset left in the fund? I mean, it's been 15 years. What's going on? He goes, yeah, well, we invested in this company and it did fantastic for us. And then, you know, attracted a lot of capital, hundreds of $1 million in valuations. We were 10x on it in about 2010, 2011. And we wanted to get out, but all the Silicon Valley investors wanted to go public. Well, it never went public. And as a result, you know, the value started to decline on it. It was no longer a 10x, 8x, 7x, whatever they eventually got out for. And they never did get out because he had to distribute the cap. He had to distribute the shares out to the partners to close the fund is what they had to do. But that's really changed over the last 10 or 15 years. The advent of the secondaries market has solved that issue and that problem. When investors want to continue on with an investment, and some investors want to get out. And that's what we're going to be talking about here today. We're going to take it from the very beginning, the secondaries. By the way, did you amend this agenda? Because I did see that secondaries got added to the title.
It's been there the whole time.
Oh, has it? Okay. When we did our prep call, we thought maybe it was just a continuation fund, but it's both sides. We were right. So it really does solve this problem. And it is and has been a huge problem in this space for a while. So we're very interested in talking about this. They're going to provide a lot more color. I'm going to ask them some questions. Hopefully you're going to ask them some questions too. We can get a little debate going up here. That'd be good. So with that, what I'd like to do is Joe, I'm going to start with you. Why don't you talk about your background, what you do, your involvement with secondaries and continuation funds.
Sure. Hi, and welcome everyone. I think we're the second to last panel of a 2-day event. Penultimate. So, you know, I'm sure it's very exciting. I don't mind that anyone stole our thunder. Hopefully we bring some more thunder. So I am a partner at Morgan Lewis, the New York office. I sit 4 floors above. My practice focuses on 2 main areas. One is fund formation, which my colleagues talked about. We're going to put that to the side for this conversation. But the other area is secondary transactions, in particular working with buyers and sellers of private fund interests, as well as lead investors going into continuation funds and the formation of continuation funds.
Megan, would you do the same?
Yes. Hi, everyone. I'm Megan Leeds. I'm at Coller Capital, which is a secondaries firm. I'm based in New York, but Coller is based in London. So I sit in the New York office. I've been at Coller for 8 years. I'm a lawyer by training and focus on the execution of these transactions. So as Joe mentioned, LP portfolio trades are one area of the secondaries market. And then we also at Coller are oftentimes the lead investor in a continuation vehicle transaction.
And,
No, please.
oh, well, I was gonna ask, throw it to Megan, but, it's given the audience, it's family offices, people adjacent to family offices. Where would you see family offices in these deals?
Yeah, so I think there are probably two primary spaces where family offices get involved. The first is as a potential investor in a secondaries fund, right? So a secondaries fund typically has LP interests or limited partnership interests in the fund, and we buy those interests on the secondaries market. So they're at the point in time when you start to see distributions coming through. So an attractive investment profile for a family office, particularly say a new family office that that wants to see distributions from day one. So that's the first place. And then the second place would be as an existing investor in a partnership, right? So if the family office is an LP in a fund that is experiencing a continuation vehicle transaction, as an LP, there's a decision to be made, and we'll go into the specifics of the continuation vehicle transactions, but the investors end up with a decision. Do you want to stay in the fund and roll alongside the continuation vehicle, or do you want to sell your interest? So that's another place where we can see family offices involved.
Yeah, so I mean, essentially, the family offices could be investors in one of
Yep.
your funds, right? For a variety of reasons, diversification, mitigating J curve, but also they could be sellers of transactions of fund
Exactly.
books that you and other secondary funds may purchase.
Yeah,
right?
that's exactly right. Yep.
And you talk about this, you're not buying new assets, right? These are assets that have existed for a while. They've grown to a certain point. New money is needed for one reason or another inside the fund. Either LPs want to get out, or the managers want to continue, and some. So talk to me a little bit about, if you would. And I totally ran off the reservation there. I'm sorry. Give me a second. Talk to me a little bit about, if you would, the term of the life of the funds at this point. How long do they normally last, or are they vary?
Yeah, so I could start with that and maybe just go into a little bit of the details of what a continuation vehicle transaction is and why sponsors are pursuing this exit avenue. So to your question about the term and why this is being used, it's pretty interesting. It started, the continuation vehicles started from a place of, we have this asset, we've been holding on to it for a long time. Our LPs are asking for liquidity or asking us to wind up the fund, and what do we do, right? But it's evolved over the last few years, and we've even seen assets that have been in a fund for as little as 2 years, right? The asset's doing extraordinarily well. Sponsor is like, wow, I can lock in my carry on this asset, and my LPs, they want distributions, or they might want to, they want to see DPI in this fund because this is the trophy asset, and they just want some cash back. So we are going to set up a new fund, and we are going to sell this asset or assets to the new fund with the approval of the LPAC, right? It's a conflicted transaction. LPAC will get involved, and the sponsor, the GP, will put in. Usually they'll roll all of their carry or a large proportion of their carry, and even put in new money and roll their GP commit. They might take some money off the table, but they are truly aligned in the continuation vehicle transaction. As a buyer in these transactions, that's the most important thing for us to see, right? Is that alignment with the sponsor who wants to keep this trophy asset, right? And so for the duration question, we're seeing a shorter and shorter duration for the hold period of that initial hold.
Yeah, and let me also take it from a different context. So that was in the realm of continuation funds and talking about those structures. But if we look back at an even more basic level, the term of a lot of the funds that family offices may invest in will be 10 to 12 years, right? And so the whole secondary market is there to provide liquidity for an otherwise illiquid asset class. And historically, the way investors would realize, they would wait till the end of the term, as Mark said, you wait 10, 12 years, and you get cash out, right? That was one option. That was historically the mode. If an investor wanted to get out early, they would sell on the secondary market, right? And so you rewind 10, 15, 20 years, you had the advent of secondary funds like Coller, who were being formed to buy those assets and creating a market for something that was otherwise illiquid. What has happened over the last several years, which has been this explosive growth with continuation funds, is that it's a method to provide liquidity and bring in secondary capital into the fund and give investors liquidity when the fund is not otherwise selling or exiting the asset through a traditional route, right? So it's not as if the fund is selling the asset through an M&A, through a strategic buyer, through an IPO, right? The fund is selling it to an affiliated fund, a continuation fund, and giving liquidity to its investors that way. So all of these structures are there to solve for the fundamental problem of investors are investing in long-term vehicles and may think they won't need the liquidity, but will want liquidity earlier than expected. And that's where we find family offices are, and other investors are frankly, living in a world where there is now this market and there is this architecture to get liquidity earlier.
How do you determine the pricing?
So that's where the secondaries buyer universe comes in. So Coller or one of our competitors, often there will be a process that's run, right? So there'll be a broker, just like an investment bank on an M&A transaction, there's usually a broker hired to run a process. The secondaries funds, my colleagues on the investment team, they analyze the asset or assets from a top-down perspective, and they come up with a price. And we submit a bid alongside our competitors usually, and the GP of the fund, chooses the pricing that they, typically the highest price, right? They also will hire a valuation agent sometimes. There's a fairness opinion given to make sure in this conflicted transaction, right? It's not just the GP setting the price. Yeah, exactly. So it's the secondaries buyer universe setting the price.
There's never a case where the company that's selling the stake is also a secondary buyer?
Well, so it's the stake that's being sold is an LP. It's a transfer of the asset from the fund, right? A selling fund to a new fund. So the selling fund, sometimes there is an M&A process.
BlackRock has a big secondary, but BlackRock had a fund and wanted to sell an interest to other secondary buyers, but also they had a secondary fund that was.
Are you talking about continuation funds or just? Okay.
Yeah, so let's say in your example, right, you could have a BlackRock GP, the fund is selling and they also have a secondaries arm. They could be a bidder in that process, right? But you would make sure you have other secondaries buyers like Coller and other of our competitors also involved in that process. But if the highest price you receive is from your affiliated party, at least you've run a process that, that multiple parties were involved in. There are some sponsors who have both a private equity fund, right, and a secondaries fund, and they have an internal policy that their secondaries team is not allowed to bid on. So that we've heard of that too in the market.
So what if it's a crossover fund? So it's going from one fund, Fund 2 to Fund 3, and they're going to reinvest in Fund 3 and also have a secondary.
So that would be a stapled transaction. Well, one second. That would be a stapled transaction. And so as part of that, that creates a conflict because the manager of the existing fund that's being sold has an interest in favoring whoever's going to be investing into the later fund. And so that creates additional conflicts that usually get disclosed to investors and have to be subject to approval. Yes.
So, given that this transaction is only happening at the LP level, and not within the fund, this doesn't impact the overall performance of the fund that they can advertise. Is that correct?
No, it's happening at the fund level. So it's happening at the fund level. So the fund will have an exit event. And then if you're an investor in the fund that wants to stay in the asset, you will become an investor in that new continuation vehicle that's set up.
I'm talking about the reported result of the fund.
Yeah, the track record, it would include,
Take a date if it's sold at a discount.
if it was sold at a discount, it would be,
Wouldn't necessarily be at a discount.
Do you have any data on what percent sell at discounts versus not?
What's the typical discount?
Well, let's,
I think what you said is just wrong. The underlying market performance, your question, is my assets, what they do. My LP wants to exit, sell to somebody else.
but this is.
Yeah,
different.
but
Doesn't affect my track record.
that's
Question.
that's 100% correct in an LP transfer,
That's-
right?
that's a
That
different-
was the question.
right? I think let us set the stage where that was an LP transfer.
Yes.
I think Megan was talking about a continuation fund transfer that's happening below the fund.
Yeah.
So in the situation where an investor is trying to get out of the fund itself, nothing's happening with the fund or the asset itself. Investor just wants to get out early, wants to transfer out early. That investor will transfer to a buyer, Coller, another secondary fund. That buyer will pay for it. Nothing happens at the fund level. There is no carry realized, there's nothing. Okay.
There's no mark to market of any kind.
No,
No.
for that transaction. What Megan
Yes.
was responding to was on the continuation fund transaction, Megan, that was where you said that the gains are essentially crystallized
Exactly.
because the asset itself is moving over
It's
from
been
the,
sold.
yeah.
And
You're-
the only question was on the continuation funds, and is there any data on what percent is sold at a loss versus a gain? Is there data taken on that?
I'm sure the brokers have, I don't have the data to hand, but I'm sure Evercore, yeah, yeah.
I can tell you it's dirty. It's completely dirty. So what
Bad
happens
data.
is that the sponsor of the fund, when they do a crossover fund or something, they're always trying to market things to their advantage. And the data is all unappreciated bullshit. It's wrong.
Yeah, I mean, we covered this like 2 years ago in Miami, and the consensus was that it's a slow drip of information.
Yeah, it's most of it.
come on in, get it in here.
Yes, thank you.
Are you generally seeing trophy assets being divested or distressed assets? And how do your investors view private equity firms that don't have a traditional exit, regardless of performance, as it relates to them?
So I'd say the market has changed in the last 10 years. It used to be zombie funds selling whatever was left, right? And trying to stay in business by raising continuation vehicle. And now we're seeing more and more blue chip sponsors with trophy assets that they just love and want to hold on to for as long as they can, and also lock in their carry, right? So we are seeing trophy assets, and so we're seeing a rise in the single asset deals as well, right? It used to be there were most of the GP-led deals were multi-asset in order to, maybe you had one good asset and then you were trying to close out the fund, so you were getting rid of the 2 other stragglers. And now we're seeing a multitude of single asset deals.
And Marty, I think we need a little clarification on your question, because you were saying, is it being sold at a discount? Discount to what? Discount to NAV? The answer is probably all of them, or a large percentage of them. A discount to an initial purchase price of what they invested in, that's probably rare.
They're marking the value of it. That's all I care about. Whatever
The-
they're marking the value of it.
So, well, then it's probably up from that, I would imagine most. Take a,
It almost never goes across the price.
Right. so
Right,
it's a third
right.
Party that issues a market value, is there a discount to that third party issuance?
I don't know the answer to that question, but usually just, I get about 10 emails a day with secondaries in them. And they all say we can get them at a discount. So that gives you a clue, right? A discount to what? But if you're looking at SpaceX, well, it was written up to a couple $2 billion, right? Well, it's true. But, well, Evelyn Gerke was on the panel earlier. They had 3 bites of that apple, and she's now trying to sell some of that.
That's a corporate, not a GP.
Well, they,
Yes, I think it's great. assets. Like there's growth 10x in the transaction the last year, but they did a special vehicle, the value strike at the same price as the euro. I feel like they got a great deal and those deals are out there. But so they were all really shitty assets. That is just-
Well, you also had sorry, there was a question about how LPs feel about these.
About subscribing or not subscribing to that.
Yeah, so I think most of these transactions on the ones that you want to invest in, the GPs are doing this, sure, to lock and carry, et cetera, but also because their LPs are asking for it, right? They need LPAC approval. They want to socialize this deal with their LPs, and they want their LPs to feel like they're doing something for their LPs, right?
Because the DPIs are so low.
Exactly. And so, yes, so the LPs are asking for these transactions when they recognize the IPO market is quiet, the M&A market is quiet. How else can you get us money? If you want us to invest in your latest fund, we need to get the money from somewhere. So can you give us some DPI, right? So we've seen in a lot of transactions, the LPs will roll into the continuation vehicle. They have a good relationship or a great relationship with the GP. They understand the rationale. And so they're, long-term counterparties with the GP. And then, if there is an LP who's not happy that the GP is doing this deal, it's usually an open dialogue. GPs value their LP relationships more than they value their relationship with the secondaries buyer, right? So they want to make sure that their LPs feel like they're doing this for the right reasons.
Yeah, and you had asked a question too, I believe, about distressed assets. And you had mentioned zombie funds. It just reminds me. So in this very room, maybe 10, 12 years ago, all of this was called zombie funds. All of it. And bankers would come by and talk about zombie funds, and then it was rebranded continuation fund. Sounds better. But I will say, for the distressed assets, historically, I mean, these structures were used for long life assets, infra deals, real estate deals, things that, yeah, you can sell 10, 12 years down the road, but there's still appreciation that could happen. They're still generating, current income. And so it might not be an asset that's suitable for a structure that has a defined term, right? And so there have been challenges on how to deal with that, right? You can do a continuation fund, you could do a perpetual, capital vehicle or something of that nature. But the continuation fund market developed because you have these assets that are longer term assets that could be in a period of distress at the end, right? Where now you're selling it for less than you think it was worth, may have further runway, maybe a trophy asset, whatever it may be. And it's a good use of that. And as people get more comfortable with the structure, you're seeing more and more deals where it's at the point where much of the deal activity now is through continuation fund structures, especially given M&A slowdown over the last couple of years.
And so what's the size of continuation fund market? Well, I can't read $140 billion.
140 billion is the entire secondaries market. It's probably an undercount. Bless you. It's probably an undercount, but half of that is continuation funds.
And just to give perspective, is that in 2008, there was probably 5 $1 billion funds, of which Coller Capital was one of them, in the secondaries market, and there wasn't a continuation fund. So talk about,
Yeah, it's
incredible
booming.
growth.
Yep.
And they were bottom feeders at the time. A closet fund.
But it's been a remarkable growth period. If you saw the statistics, I mean, it's, basically like this. And it's expected to grow more and more because, several years ago, I would have conversations with other leading lawyers in the industry, and we would get together, I was telling you earlier, for dinner and talk about how we can make these deals happen, right? A lot of the deals were breaking because there are these conflicts, there are these issues. And as people got more comfortable with dealing with the conflicts and dealing with the friction points around valuation, more and more of these deals started to happen as people started seeing, oh, they are a good use to, generate cash flow for our investors, crystallize carry, hold on to assets, whatever it may be. there was a lot of market acceptance.
Yeah, I think once a few blue chip sponsors started doing them, that's when the floodgates kind of opened because no GP wants to be seen as a zombie fund, right? And so once that nomenclature stopped being used and these were seen as a legitimate path to DPI, more and more of these bigger sponsors have gotten into the market. And now you're seeing many more mid-market GPs pursuing these transactions. It's a lot of work for a GP to do one of these, right? It's a fundraise, right? You're raising a pool of capital. It's also an M&A type sale process. And all of the various teams within the sponsor have to get involved, right? The finance team, the legal team, tax team, all those teams. So it's a big undertaking, particularly for smaller managers who might not have as many internal resources.
So there's two things. One, they're actually now marketing a little bit differently too. A lot of the funds now, specialized funds managers, where they actually require the GPs to put more capital continuation funds. So the GPs are actually throwing their own money on top of it.
Yes.
The LPs have a choice whether to play or not, but it makes a difference. Some of the terms of those funds have been very, very good because it's all the best assets. There's no J curve. You're just getting the cream of the crop. The whole thing. So those have been doing very well in fundraising very quickly.
Yeah, I think those are when you see the GP putting additional capital in, right? That's when you think the alignment here is really strong
And
from a
alignment is,
buy side perspective.
yeah, and alignment, from a buyer's perspective is a critical issue here. Given the GP's conflicts, the more the GP puts in, rolling over carry, new commitments, the better a buyer is going to feel about funding that continuation fund. And so we're seeing significant amounts of capital being put in from the GP. And, you know, that further buttresses the story that this is a trophy asset and will do well.
Rob, I saw your hand up. You want to fire in? Then I'll come back to you.
Our preference is more active and involved ownership investment. When you secondary transactions, how do you get comfortable with if a situation, if there's a bump in the road or there's an event that requires more hands-on?
Yep.
Is there trust in the GP that sort of manage it, or do you have certain secure rights?
Yeah, I'd say in the typical transaction, we would have
Before you
them.
do that, could you just, for the sake of the online audience, repeat the question because they can't
Oh,
hear.
sure.
So we've had a couple requests from them. So-
Okay, yeah. So the question was around getting comfortable having, as to what rights we have in a situation where something's going wrong at the underlying company level. So I'd say the short answer is we're reliant on the GPs to a large extent, right? So we make sure that we are aligned with those GPs in terms of economic incentives, right? That they have the right incentive model in place. But we also sometimes have a board observer seat at the company level if it's a large enough investment for us. And we have robust conflicts protections in the LPA for any situation where we think maybe this GP, maybe they do another continuation vehicle, right, on this vehicle, which we've seen happen, and maybe they're no longer aligned with us. So we really try to make sure that the GP stays aligned with us. And then, this standard GP removal provisions, if there is something going wrong at the GP level. But our diligence is on the company, but also on the GPs, right? So we're making sure that those GPs are GPs we've known for a long time. We've done other transactions with in the past. And if it is a new relationship, that we're getting to know them and know the individuals and make sure that they're sticking around.
Yeah, and I would just add a couple things. So in the context of a traditional secondary where secondary fund is buying into a fund in your example, there are very few rights, right? You could have a large position of fund. You could wind up buying a lot of different investors' pieces of a fund and wind up with a large percentage ownership of the fund. The secondary fund may not have much of a voice. In the continuation fund context, it's much more of a bilateral negotiation if the secondary fund buyer is the lead investor. The lead investor in one of these continuation fund deals will set a lot of the terms. They may have the right to enforce the purchase agreement on behalf of the continuation fund
Yes.
against the selling fund. They may have board seats at the underlying company level or board observer seats. They may have consultation rights, veto rights, a lot of those kinds of blocking rights that you would expect in many M&A transactions, right? And so it's not completely to the same extent as if you were investing directly in the company, that amount of capital and having those rights, but it's going a lot further than traditional secondary deals ever would for the control rights that a secondary buyer would have. That's in the context of the lead investor. These deals are often syndicated, and there are multiple smaller investors that will go along with the lead investors, and they are largely piggybacking off of the lead investor's work and rights that the lead investor negotiated for itself.
Hold up just a second. He's got a question first and we'll come back to you.
I have a follow on to what he just said.
Well,
Why do you-
okay.
I'm just saying, when a GP stake is sold, do they sell their stake in entirety?
Are you talking about a GP stake or the
A
L?
GP into a continuation fund, a stake into, so they're selling a stake in a company, I guess, if they own, right? Part of the
Yeah, so it's
portfolio?
the existing
go
fund
in
selling,
Or a fraction.
it's usually
Usually all. of it.
usually all, it could be a fraction, but usually all of its interest in a company is getting moved over from the existing fund, moved over to a continuation fund.
And minimally, you get all the GP rights and then you can negotiate for more.
The GP is going to keep the same rights, but the lead investor is going to have rights to keep the GP honest.
So at the underlying company, so if you're talking about the stake in the underlying company, let's say it's one company, the rights that you have at the shareholder level at the company don't change, right? You are a shareholder in the
All those
company.
GP rights
and
in the
so-
company get transferred over.
Yes, so if you have a board seat or two board seats, you're the GP, you continue to have those board seats. What Joe is talking about is the LP investors' rights vis-a-vis the fund, right? So the fund has those rights at the company level, right? And then within the fund, if you're the secondary investor, you might ask the GP and negotiate for rights, but those between you and the GP,
But
right?
you may have one of the board
You might
seats.
have a board
Yeah, you might
observer
have
seat at
one
the
of-
company
Yeah,
that the GP goes to the company and says, hey, we have a new investor, we want this. Sometimes your rights as an LP, you could have, if you don't run a sale process within 4 years, at year 4, you agree to run a sale process. It doesn't mean you have to sell, but like, we want you to run a sale process at that time or
Do you know
something like
what
that.
the- I hate to say, do we know what the performance of continuation funds is? Are they making 15% on average or?
I think the challenge in answering that question is the ones that have done well are done, right? They've sold, the assets sold, right? The ones that are still, the assets still being held in the continuation vehicle, to your point earlier, I think it's, those valuations are the GP's valuations, right? So you don't, it's the market's too new to,
Coller has a continuation fund?
no,
Okay,
we
but-
invest in
If
continuation
somebody
vehicles.
has a continuation fund, do they do continuation fund 1, continuation fund 2?
Some do, but it's still,
Very nascent.
yeah, and there are a few examples of continuation fund 2 on that same asset that continuation fund
Yeah.
1 was done on.
stacking
But
continuation.
Those are,
funds.
they're just a few of those.
And so I just had somebody, maybe ChatGPT told me that we can assume that the average write down in an asset on a regular secondary sale is like 5 to 10%. I think it's safe to assume that on continuation fund, it's about the same. So that means if you go to fund 2 continuation fund, it's another write down.
But if the NAV has increased,
That could be
Yeah.
true. Okay,
Yeah.
okay, so I'm sorry.
You should defer back to him now.
So Coller has help, you all have help.
yes,
right?
yes.
And is that a fund structure?
Yes, so we have private funds.
Is
Yep.
the tenor of that, say, 5-year?
It's a 10-year, yeah.
Because typically continuation funds have it be a 5 years.
Yes. So our fund is primarily made up of secondaries investments. Then we also have co-investments, which are a little bit longer duration. and some other, yeah. But-
Now, I'm going to just bring this back to the family offices. What are the potential tripwires that they should be careful of in getting involved in a continuation fund? What are the things they should be looking for that's different than going into a typical asset they might go into?
You want to take it?
Yeah.
There are different angles in which a family office may be involved, right? So the first thing I would say is their family office could be an investor in a secondary fund that's going to participate in these deals. As an investor of a secondary fund that may, invest in a continuation fund, they'll be very passive. On the other hand, they may also be brought into deals, either as co-investors or through co-invest vehicles, right? So family offices may be investors in the continuation funds, either directly or more likely indirectly. And understanding these structures would be helpful to underwrite their investments in the secondary funds in the first place. So that's the first angle. The second angle is that family offices that are investors in funds that are going to go through a continuation fund process on exit will be given election packets as to whether or not they want to cash out in that deal, or whether or not they want to roll over into the continuation fund. Do they want to participate in the continuation fund? And that's going to be an underwriting decision that's going to have to be made at that time by the family office. Frequently, it's not a lot of time, 30 days, right? And you'll have 30 days to underwrite whether or not to participate in the continuation fund. If you don't want to participate in the continuation fund, you can sell out. And you just sign your name, sell out, you're gonna get your share of the purchase price minus expenses, and that's it. If you wanna roll over into the continuation fund, there are certain things you'd wanna look for. Are the terms the same for you? Are you being subject to additional fees that you otherwise wouldn't expect? Or is there a status quo option where the terms are the same and you can be comfortable that you're not getting jammed? At least on terms, you're obviously going to be invested for a longer time period, but it's roughly the same. Your side letter is transferring, your rights are transferring and whatnot. So that's an analysis as to whether or not you want to do that. To help with that analysis, managers will come out with what's called a confidential information memorandum, fancy just for a disclosure packet. This will disclose the price, how the price was set, how the auction was run, why they think it's a good deal, and what your options are and what the conflicts and risks are if you choose either one of the sell or roll options. And so family offices will have that decision to make and will have to make that underwriting decision. Because these are so prevalent, our investor side clients are seeing these come all the time and they don't know what to do with it. Most investors are selling because the underwriting decision is too quick and or too complicated to make in that time period. But as people get more aware of these and more familiar with them, maybe you'll see more investors roll.
And I'm assuming if they want to put in more money, they can do that as well.
So often this is another point of, challenge here is often there's an ask for follow-on capital, right? So a GP might be doing one of these transactions because they want to do some more M&A activity at the company level and they just don't have the capital in their existing fund to do that. And so when the sell roll decision comes to an LP, it might be sell, roll, plus an extra check, right? So that's also something to keep in mind with these. In terms of investing additional capital, it depends on how subscribed the deal is on the buy side. So if it's a smaller transaction or just one that the secondaries universe thinks is very attractive, often the entire buy side will be spoken for. So you can just roll your existing commitment. But there are some deals that are, multi-billions of dollars and they're hard to syndicate.